Hey everyone, I'm Jeremy Szafron. This is Kitco News. If you're looking for the latest insights and analysis on the markets, well, you found it. Don't forget to hit that subscribe button. Now, today we're seeing a mixed reaction in the markets following the release of the Producer Price Index for April, or the PPI, which showed a notable increase of 0.5%, exceeding expectations. Now, this uptick suggests that while overall inflation pressures remain, some underlying components are showing signs of cooling. And meanwhile, the S&P and broader markets are holding quite steady here. So let's discuss strategies for navigating the current markets, especially considering recent shifts in sectors like utilities, which have surprisingly outperformed. Now, our next guest, Ed Butowsky of Chapwood Investments, is a seasoned wealth manager for high net worth individuals, pro athletes, and celebrities. Some you might even know. Previously nailed his call on utility stocks, and he's here to share his current outlook on the market. Ed, good to see you again.
Great. Thanks for having me.
Yeah, I appreciate this. Let's start with the economy. We saw some latest numbers. Today's PPI data came in a little higher than expected. But given your knack for reading the market, what's your take on this? Were there any surprises? What's your thought on the economy's health here?
Well, I'll tell you, the economy itself is doing very poorly. The GDP number was down and was much lower than what people expected. So normally when you have a GDP number that's very low, you would think that interest rates would be reduced to stimulate the economy. But sadly, you can't do that because you have to get inflation pressures under control. And in order to do that, you have to raise interest rates to slow inflation down. So you really have stagflation, which is the worst economic condition you could have at this point.
Yeah, and the Fed talking a little bit today. I know Jerome Powell was on a stage discussing that this might be longer, a little bit higher for longer. They're waiting on these to come down. So with the core components that influence the Fed's decision showing more restraint, what's your predictions here from the central bank? What do you think the Fed's going to do? And more importantly, how should investors prepare for it?
Well, investors should be prepared for higher interest rates. Remember that the Fed only controls the Fed fund rate and the discount rate. All the other rates trade based on supply and demand. And I think the demand is going to be very limited in terms of interest rates going higher. So I really believe that you're going to see mortgage rates start to creep a little bit higher, and interest rates on credit cards are going to go higher, which is not going to be very good for the economy at all.
Yeah, well, let's talk a little bit about your last visit. I mean, you pinpointed utility stocks as a sector to watch. Indeed, they've outperformed. It's always nice having a guest come on and call it correctly, Ed. Here's what you said.
And if you look at the Magnificent Seven, they're all tremendously overpriced based on expected earnings right now. So I'm avoiding the Magnificent Seven, and I'm doing something really boring. I'm investing in utility stocks. Utilities have come under a lot of pressure last year as interest rates rose. And the idea is that interest rates are going to start to drop, and you're going to see natural gas prices have dropped as well. And as a result of gas prices dropping, you're going to see a windfall profit coming into these utilities because they generate a lot of their energy from natural gas and coal. So there's going to be a profit, unspoken or unknown profit to a lot of these utility companies.
Yeah, and that profit rather is certainly telling. We've seen quite a few of these utility stocks outperform. Any specifics here, Ed, that you can talk a little bit about these returns? Who outperformed for you? Were you surprised here?
Well, NextEra has outperformed tremendously. That's NEE, and Dominion Resources has outperformed. But if you look at the whole sector looks really attractive. Even if interest rates creep a little higher, you're still going to see profits that come from natural gas prices being lower and coal being lower. So there's going to be that hidden profit in those. And I think that's a really wonderful place to be putting money. Even today, you're going to be looking at income of about 3.5–4%, and then the potential for growth. So I'm looking for a total return on utilities as a general rule of about 12% for the next 12 months.
Okay, so you're still long in utilities. Any advice for the audience on some specifics? I mean, you mentioned NEE, Dominion. Any others that you're looking at here that maybe might outperform this 2024, this later in the year?
Well, I think NEE is the largest and the best one to be in. It's involved with green energy as well, and they're kind of the largest utility company. So if you look at any of the indexes, NEE represents about 17% of the index, and that's where I would be focused my attention.
Okay. I mean, given the unpredictability of energy prices, we've seen oil and gas prices, with OPEC, supply demand issues kind of come off. Is there any impacts on the utility stocks here? How are you adjusting your strategies to hedge against any potential volatility?
Well, I'm really not doing any hedging at all because
Okay.
I don't believe interest rates are going to go that much higher, if they do go high at all. So I'm just kind of sitting there and just hoping that things go the right direction, and they have been. The hedging costs money, and that takes money away from the profits that you're going to make. So I don't do a lot of hedging on utilities.
Okay, well, let's talk about the current market dynamics and where you're seeing some similar untapped value now. I mean, you advise a lot of people. You're still long in utilities, but where else are you looking here, Ed?
Well, I'll tell you, there's a biotech ETF that I really like called LABU, LABU, and it is 3 times the profit on the biotech market. And if interest rates drop, biotechs are very heavy borrowers. And if interest rates drop, that will proportionally help biotech stocks quite a bit. So I'm really banking on interest rates starting to come lower sometime in June, July, or even August. And if so, I think LABU is going to do very, very well. So I would be putting a little bit, maybe 5% of your portfolio in a leveraged ETF called LABU. And that's a riskier play. That's for your tactical allocation, not your strategic allocation. The tactical allocation is something that you do that is to accentuate the strategic portfolio. Your strategic portfolio is your absolute allocation, and tactical is something you lay on top of it to get better gains.
Yeah, I mean, the last time we had you on, I mean, it was only February, but you were talking about the S&P kind of taking a little bit of a breath, that Magnificent Seven, and it seems as though that's continued to happen. I mean, AI is definitely playing into the tech stocks, but is that kind of your assessment here? Are we still a little bit heavy in the tech side on the S&P?
Not only heavy on the tech side, but heavy in NVIDIA. I mean, NVIDIA up and through April represented 37% of the gain of the S&P. So if the S&P was up 6%, 37% of that was NVIDIA, and then the rest of it was Meta. So now you did start to see Bristol Myers come into the fold because of its weight loss drug. So you're starting to see a little bit more broadening out of the S&P 500, but the tech stocks are really the ones, the information technology stocks are the ones that are really leading the way.
Okay, I mean, we've seen a lot of precious metal stocks. Really on the equity side, it hasn't caught up to the price of the metals. But I'm curious, is there any, I mean, you mentioned you're not really hedging about anything, but are you keeping an eye on gold prices and different metal prices here in this market too?
Yeah, I am. I hesitate to buy gold. It's just a personal thing. I just don't like buying gold or silver.
Yeah.
But there are a couple of stocks that there's a couple of ETFs. One is called corn, one is called soy, and this is put out by Textrion. And these invest directly into the commodities. And I do believe that commodity prices are going to start to rise pretty soon as we get further into the summer months.
Yeah,
so
very
those
cyclical.
are things that I like quite a bit. But I really hesitate gold. I always have. I've never been an investor in gold. I don't think gold is a really good inflation hedge. It has never proven to be. Everyone says it's a great inflation hedge, but it's never been proven to be.
Yeah, even with those central banks out there just picking it up like this stuff's, hot.
Yeah, yeah. No, I'm just not a big gold bug.
Okay, well, listen, it's an interesting time out there. We've seen the markets this year so far obviously kind of go up a little bit. They've come off slightly, waiting for this inflationary pressure to kind of take a little bit of a hit. But as we go into summer, it feels like it's not really a sell in May, go away type of market. So as you talk to your clients, what are the key strategies that you're advising them to employ right now and for the rest of the year here, Ed?
Sure. Well, we're very much into income plus growth. So we're invested in business development companies and senior rate floating notes, preferreds, and we're starting to pick away at the REIT market. There's a number of REITs that we like, the healthcare REITs and the digital REITs, the digital, what are they called? The banks that where the servers are. We're starting
Right.
to play a little bit into those, and also the public storage REITs. The retail REITs we're staying away from, but we also believe that the commercial real estate REITs have gotten beat up so badly that they're starting to look somewhat attractive right now. But one that we really like is RIET, which is a home residential REIT, and that pays a nice dividend, and it has income plus growth, but mainly it has growth and then income. So we're
Yeah.
starting to look at those as well.
It seems like there's a lot of people that are playing on the REIT side, but not touching the commercial real estate area. Still too much there, still too much leverage, too much debt to kind of get involved there.
Yeah, but the banks, I think, have it under control. I think that if you look at some of the sobering reports, you hear that about 25% of the REIT market is going to have to, or commercial real estate is going to have to refinance over the next year. And they're going to have to refinance at much higher rates. But I think the banks are in a good position to do that refinancing. And I think a lot of the commercial real estate is solid enough to withstand any of the negative implications.
Yeah, is there anything that concerns you, Ed, when it comes to U.S. debt? When you start looking at this debt, when you start to kind of take an idea, basically you start to look at how much they're paying to just service the debt. And does it make you worried about the future? I mean, what's your outlook considering the mixed economic signals from, job growth, government hiring? What's your outlook for the U.S. economy through to the end of this year?
Yeah, I think the U.S. economy is in really poor shape. You have $1 trillion of interest payments now that go out from the government. And that's about 25% of what we bring in tax revenue. So 25% of our tax revenue is going out in interest payments to pay for our public debt, which is just not sustainable at all. And the U.S. economy needs a shot in the arm. And it's only going to get it if interest rates drop. That's the only way we're going to get a stimulation in the U.S. economy. And as long as inflation's running high, we're not going to see that happen. So I'm not really that strong on the U.S. economy. And I think the U.S. dollar is going to get weaker, which is by design, which will make our exports look more attractive. Because you want a weaker dollar to make our exports look more attractive. But a weaker dollar is also not very good for the economy.
Yeah, quickly here, do you have any interest in looking at the broader markets globally, some of the emerging markets? I know I talked to some analysts and they predict higher returns looking elsewhere than the U.S. right now.
Yeah, I do. I like Africa quite a bit. There's a great fund called the Nile Fund, NILE, which represents a lot of Africa. And South America is a very, very confusing place because there's so many different pockets there. You have Argentina, Peru, Brazil, and Brazil, should be, this phenomenal growth story, but its politics have really screwed things up. Now, Argentina is, getting itself out of its own way with the new administration. So I think Argentina is going to be a great growth story. And then if you look over in South Korea, that's really, can go either way at this point because of what's going on with China and Japan.
Mm-hmm. Yeah, in South Korea, it's interesting there to take note of their short banning rule that takes place. I'm looking at these meme stocks. They're making a comeback here, Ed. Obviously, you're not going to your clients and saying, hey, go and pick up a bunch of GameStop, but it's up $220 in the past 5 days, pushing the Russell 2000 up. Are you seeing some lift here? Is there any, small caps that we should be looking at, or is this just more smoke than fire and we're going to watch this thing all come down?
I think it's just more smoke than fire. I see these headlines. I get, printouts at AMC and GameStop and even DJT, which is Donald J. Trump's company, becoming a meme stock. I really, as I advise clients, I cannot advise a client to buy any of those. And I kind of look at them and think, that'd be kind of fun to play. But then it would take away all my time staring at that every day.
Yeah, not really worth the return. I guess for some, it might be. Okay, well, I'll leave you with this because I know you got to go and we're almost out of time. But with all these factors in play, if you could offer one overarching piece of advice to our viewers looking to protect and to grow their investment in these times as we see this economic data come out, what is it? What would it be?
Make sure you have income that is predictable off of your investments. You those stocks tend to go down less when there's a big sell-off because people want to continue to get the income off of them. And it's always nice to get income off of investments. And don't shorten your time horizon. That's the other thing that people are doing too much with being able to look at their phones 24/7 and value what their net worth is, instantly. Don't do that. The best returns are the ones that when you don't look at your phone and don't look every single day at what your value of your account is. So, it's time, not timing in the market.
Keep calm and carry on. Ed Butowsky joining us today from Texas. Hey, thanks for this. Your insights are always invaluable. And we'll have you on in the future. Maybe we can go back and look at another one of these wins.
Thank you.
Thanks, Ed. Appreciate it. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. We'll have plenty of great content coming up. So hit that like button and subscribe, and we'll see you soon.